Welcome to the daily update, where I'll go over the action in the market for Friday, November 15th, and we'll see how things look for Monday, November 18th. Another negative day. Yeah, we're seeing some weakness coming into the market, but for right now, the 20-period simple moving average in the short term is still holding. We dropped a bit below that, but we were able to close above that. And you could probably say, and this is just a personal observation, that FOMO is pretty much finished, the fear of missing out. And that's what happens. We had a big emotional up move after the election. People were like tripping over themselves to throw money into the market. And now comes the time when that ends, and there's a period of doubt saying, uh-oh, did I do the wrong thing? Maybe I better get out. I'm not seeing too much of a loss yet, but it is a loss, and maybe I didn't do the right thing after all. And every time I get into the market does the opposite of what I wanted to do. If I buy, it goes down. If I sell, it goes up. That's what the market likes to do. It plays with your mind. And that's why we look at charts. We try to take an as unemotional approach to the analysis as possible because it's not always going to feel right or wrong at any given time. And so we look at charts that tell us what's actually going on. And that's why I look at a lot of different charts because I'm trying to reach a consensus. Chris Shavacco, he calls it the weight of the evidence approach. I call it the consensus approach or consensus method. Okay, before I get into that, there's a thing called the SPX Investing Program. It's free until the end of 2024. Feel free to check that out. There's a link that'll take you to the website or to a video. One benefit is that you get access to the videos as they are available. And the daily video is the real foundation of the analysis that I do. Now that we're at the weekend, I will be preparing all of the outside videos, but they're meant to tie into the daily video. Okay, so right at the open, we had a gap lower open. Now the futures were already negative. We've been drifting lower, and then we had retail sales come out, and it didn't really do all that much. And so we ended up having a gap lower, in fact, more of a negative reaction after the reports came in. So we opened below S2 at 59.10. Then we just continued a steady decline. There wasn't a lot of choppiness. We just kept going down, down, down. We found support slightly below S3 at 58.59. So we broke below that 5,900 level and we closed slightly above S3. So just a little bit off the lows. We were down 1.32% on above average volume. Now, this was options expiration. The monthly options expired on Friday. We are still positive, but looking a bit vulnerable now in the short and intermediate term. We're still positive in the long term. And the market's starting to develop this concern that these economic reports that are coming out are a little stronger than they thought they would be. And this idea that the Fed's just going to automatically come in and cut rates at their December meeting, that's kind of into doubt right now. Now, we could shift back. That's why we follow these charts about the probability of what will the rates be after the next meeting. And you can see that they fluctuate all the time. And I go over those in the weekly video. And inflation, there's a lot of talk now because of the change in administration. There's a promotion of economic growth, fewer regulations. There's at least talk anyway of overhauling a lot of things within the government. And that's dealing in areas that messes with the status quo. And the market might be a little uneasy because of that. Even though they might see it as a positive thing, it's like, okay, what's it gonna take to get there? What are we gonna have to go through in the meantime? And some folks that I respect and I listen to are still calling for a recession. Other folks are not. We still have a mixed picture when it comes to the different charts that we look at. And then we want to keep an eye on the geopolitical things. Now, they've been pushed to the back, at least in the news cycle, as the election is kind of fading off into the distance, but that could come back into the forefront at any time. Large caps and semiconductors underperformed in Friday's session. They got hit. Growth took a pretty big hit. And at least on the positive side, the simple moving average. Now we're below the exponential moving average, and I'll show you the chart, but we are still above the 20 period simple moving average. And that's what most folks use are simple moving averages. Now you might use 19, 21 days, 18 and a half days, 23, whatever. I've settled on a 20 period simple moving average that I use to define the short-term trend. We want to keep an eye on the Middle East. Oil actually it just hasn't really been bouncing around all that much. We're still looking extreme with our stochastics, with our longer term version on that chart. But everything else is coming down right now. Well, our list is wiped off as far as extreme positive readings with our short-term indicators. We still have the Sean trend meter, but even it's coming down now. We have nothing in the long term. We drop below the 150 and 200-day moving averages, and I'll show you that chart as well, where sometimes when we go above those lines, we look extreme positive. And I added one little sentence here to the scenario that, yeah, the Fed's been cutting rates. The market is still anticipating a soft landing, but now there are doubts that are rising about future rate cuts. It's not as much of a given as they actually thought. But that could always switch back to it being a given again. The dollar was down and interest rates were up. They were all over the place. But by the time the 10-year yield actually closed, it was at 4.343%, where it had been at 4.42%. So it just ticked up a little bit, but they were quite a bit higher. But them coming back down didn't bleed over and help stocks. We're getting closer, but we're still inverted with the 10 to the 3-month yield curve. It's coming up, but it's not quite crossed back over yet. Where with the 10 to the 2, we're still uninverted there. And we've gone all the way down to neutral as far as sentiment. Now, you could take this as more negative because we saw it coming down on Thursday, we saw it coming down on Friday, and that means that folks are getting more pessimistic. So the context is that things are turning more negative from a sentiment state. And we've changed here with our trend. The red line has crossed above the green line with the ADX. It's still below its moving average, so it's a weakening trend, but we're still getting an ADX reading above 20. So that suggests that we are in a trending environment, but it's a weakening trend and it's now turned negative. The bias is negative with the down day, and now I've switched our momentum to negative. This was just not a very good week. Previous week was one of the best weeks we've ever seen, and it's the best we ever have seen after an election. But there just wasn't a lot of follow through this week. And we haven't necessarily fallen apart, but it's kind of throwing things into doubt. It's like, okay, well, were the gains that we saw in the previous week, were they justified? Some of this could be profit taking. Some of this could be that a little bit of uncertainty as more things are coming out about what the new administration is planning on doing. All right, economic reports that came out. We had the New York Fed Empire State Manufacturing Survey came in a lot stronger than expected. They thought it would come out at 3.3. It came in at 31.2. Last time it was at a minus 11.9. Anytime you see a number above zero, that's showing expansion. Kind of like with the other things that we look at, if it's above or below 50. Well, with this, it's whether it's above or below zero. Total retail sales, probably the biggest report of the day and one of the bigger reports of the month, came in a little stronger than expected. They thought it would come in at 0.3%, being up. It was up 0.4%. Last month, it was up 0.8%. When you take out autos, it was up 0.1% month over month, less than the 0.2% they thought. And last month, it was actually up a full percent. Import prices were up 0.3% month over month, which translates into 0.8% year over year. When you take out fuel, it was up 0.2% month over month, 2.3% year over year. Export prices up 0.8% month over month. That translates over into a minus 0.1% year over year. You take out ag products and prices were up 0.6% month over month, but flat year over year. Total industrial production came in down 0.3% as expected. Last time it was down 0.5%. Year over year, it's down 0.3%. Capacity utilization came in weaker than expected. They thought it would come in at 77.3. It came in at 77.1. Last time it was at 77.4. Business inventories up 0.1% month over month. They expected it to be up a little more than that, up 0.2%. Last time it was up 0.3%. Okay, so here's some charts. Core retail sales year over year, pretty much flat overall, but still positive. Month over month, up, but down from the previous reading for retail sales. Industrial production kind of going around just a little bit below the zero line when you look at it on a year over year basis, and capacity utilization is flat to slightly declining year over year. Here's capacity utilization. We're the 80% level. That's when we're at full capacity. We're down below the 78 range. We're getting into the 77s now. Month over month with production was negative, but less than what we saw the previous month. And the New York Empire State Manufacturing Index, a big jump there after it had been quite negative over the last year. We got a positive reading back in September and then it dropped back to negative. This is a pretty big bump. And Isabel Net block charts, real investment advice. And I'm also going to show this in the intermarket analysis video with valuations. This is just showing the Schiller PE ratio here and then comparing it to what is actually happening, the real price that takes inflation into account. And it's just kind of showing they're both tending to go in the same basic direction. And then they have bubble with a question mark here. And then post-election rallies are the norm. Well, tell that to this week. So we have the lead up to the election and then usually what happens and the different presidents and what happened after that. And then US equities are undeniably expensive. Well, I've been saying that for 2 or 3 years now. When either we look at historical PE ratios and even looking at forward PE ratios, yeah, we're we're pretty overpriced right now, and that could justify things going down. But we've been in this place for a long time where it didn't necessarily justify prices going down. And then recent negative revisions to the consensus for 2025 earnings per share, where it's still coming in solid. And you've got the Magnificent Seven stocks that are adding most to the earnings, where we're back down to zero now with the S&P 500. And if you take the other stocks, you take out the Magnificent Seven, last time I checked, there are 503 stocks that make up the S&P. It's not just 500 minus 7, but they come up with 493, and the earnings going forward are actually negative 3%. Okay, and then which countries would be most hit by tariffs? Now, the debate's going back and forth. Some people say tariffs are a good thing. There's been some talk about either doing away with the income tax, but we've heard all this talk before, and you just kind of have to take it for what it is until it really happens. But companies or countries like Mexico and Canada, they're, our neighbor to the north, our neighbor to the south. They're going to get hit pretty hard here. And then a lot of people think these tariffs are really aimed at China, but they're kind of further down on the list here right now. And the debate, whether this is a good way to do things or a bad way to do things, you can come out on either side. I'll probably be addressing this in one of the supplemental videos that I'll put on the website at some point, but I want to do some more research first. And then this is just showing how real yields get real. We're going back up now here with the 10-year yield. This is the tips, and I go over some of these charts. These are Treasury inflation protected securities. They've been going up. And they started going up after the Fed started cutting interest rates. What's going on there? Is there some anticipation of inflation coming back in? Did the Fed cut rates too much too soon? Of course, you got a whole camp that says that. And then another one, remember last August when they said, we need a 0.5% cut today, and then we need another one at a 1.5 at their next meeting. Well, that died away quickly. That's just rhetoric. That's just the financial media trying to build on people's emotions. What we do is we look at the charts here, and I've been watching this and I've been talking about it because we're trying to get the context for why is this actually happening. And I'll continue to keep an eye on this. Then we did have options expiration in Friday's session. It just shows you these are all the options that are going to be expiring. Whole lot of stuff. And that's why we see a real pickup in volume on those days. And then half of the S&P 500 options continue to be 0-day options. And that's kind of the new craze these days. I don't do it myself. Zero DTE. There are some folks out there, and I get asked every once in a while, but I don't do that. So if you're watching this video for the first time, or if you're wondering, do I cover those things? No, I don't. Then this is what's giving the market some spookiness right now, is that we're seeing the economic surprise index actually really going up. That means that economic reports are coming in stronger than expected, and this is causing some concern in the market. I looked at Twitter but didn't find anything interesting. Yardeni really hasn't published anything here. So here's the intraday chart where we did gap down at S2, and then we just kind of trailed our way all the way down to S3. We found some support right around the S3 level, tried to bounce up off of that a little bit, and ended up closing slightly above S3. And we were negative even before the market opened here. We were going down in the initial overnight session. We kept going negative in the overnight session. And then that bled over into the cash session. And then we trailed off there as well. And we're pretty much flat as things close for the weekend. And seeing some weakness here. Now, the blue line's still above the red line. That's the positive side. But the fact that the blue line really came down after it had been outperforming, that just shows that growth really took a hit. And that's more negative for the market. And then here's the growth to value ratio for the S&P. I've been going back to Halloween and saying, look at how this is going. Well, we broke that trend. We saw real weakness in growth in Friday's session, which is causing some concern. So we were down over 2% with growth with the large caps. We were down 1/3% with value. Growth was down more with the mid caps and also down more with the small caps. So we look at our ratios here where we were seeing some improvement with small cap growth to value. That's falling back now. Mid cap growth to value was improving. It's falling back. And we're falling down below the 50-day moving average, even when we look at S&P growth to value, but it's still in a longer term uptrend. Now, is this short term? Is this just something that happened in Friday's session and then we're going to turn and go back up? Or are we going to see more follow through to the downside here and actually have things drop below the 200-day moving average? That would be more negative. And we came back down to the top end of the rainbow when we look at the growth versus value ETF. But this is holding up fairly well. Discretionary to staples, yeah, not so bad. But mostly it was weakness in staples that, and even though discretionary was down, staples were down more. And that's what's helping this ratio to stay at a higher level. Our trend, we have crossed over negative now. The red line is going above the green line. We're below the moving average, so that's a weakening trend, but we're still above 20. But the intermediate term trend is now switched over where we default to negative, even though we're still above the 20 and 50-day moving averages. Also crossing negative here in the short term with the red line going above the green line. Volume did pick up because of options expiration, but this has been one encouraging sign. As we were going sideways to slightly lower, we were seeing volume dropping off, and that could be positive. That means there's not a lot of selling into the sideways to weaker action that we've seen. Now, Friday was kind of its own day because it is options expiration. Sentiment, we went back up with the VIX, both with the line chart and the bar chart. The VIX of the VIX is also going back up, which is they usually move in tandem with each other. And so we're kind of getting more into the middle part of November where maybe we're seeing a little bit of a spike up now with the VIX seasonally. The momentum, though, for the VIX continues to be down as measured by the MACD. We were up slightly here with this fear gauge, and we went up with this other fear gauge. So we're seeing some confirmation there that fear is coming back into the market. We declined with the daily equity put call ratio, but we're going back up with the 5-day after getting extreme here, and that tends to be negative. We're still declining with the 10-day, and that tends to be positive. So shorter term is looking more negative. 10 days a little further out, that's still going down. But we're not getting a really high reading here with the volatility risk premium. That fear continues to be below the band and actually declining. Seeing some weakness here with the advanced decline line based on price and volume, but still above advancing moving averages. Really declining with the 5-day when we look at the new highs minus the new lows. A big drop off in the new highs, a bit of an expansion in the new lows. So we're starting to turn down with our 10-day. That's showing a little bit of weakness. We're turning negative here with accumulation distribution. We dropped below the moving average after Thursday. We continue to be below the moving average after Friday. And in the short term, we've dropped below zero with the advanced decline ratio. We're declining, but still above zero with the intermediate term. And we're still negative here. And this is something that I was pretty much watching all week. It started to develop a week ago Friday, where we just weren't seeing much of an improvement here. This measures price and volume together, and we were chopping sideways, and now we're starting to drift lower, and the red line's going down. And so this actually has turned negative, where we were kind of watching it. We were concerned about it. Well, now it's starting to play out to this point that things are turning more negative. And we're dropping below zero and declining with the Chaikin oscillator. So our second smart money indicator is also negative. We're still positive with the vortex, but the green line's coming down as the red line's coming up. And so we saw when we look at the cumulative advanced decline line for the S&P based on price declining, also declining based on volume. We never did break out based on price. We did break out and set a new high here based on volume. Dropping below the moving average with the cumulative advanced decline line for the NYSE, dropping below the moving average here with our regular NYSE advanced decline line, a little bit below the moving average here with this other NYSE advanced decline line. So we're seeing some weakness here with common stock based on price and volume. Dropping below the moving average with the NYSE common stock. That's turning things a little more negative. We'll have to see because we dropped below it right at the end of October into November, but then we were able to get back above this. So for right now, this is turning more negative, but it doesn't mean the end of the world necessarily. Coming right down to the moving average with the S&P, down to the moving average with the mid caps, and also starting to drop below with the small caps. Of course, small caps had their one or two really solid days and then spend the next number of days seeming to give that back up. So we're seeing a decline here with the S&P, and then we plot the NYSE advanced decline line on here. Not seeing that much of a differential between the two. We're declining, but still above 50 with those stocks above their 20-period moving averages. We're declining with the 50-period moving average study, but still positive since we're above 50. Declining with the 100-period moving average study, and also really coming down with the 200-period moving average study. So we broke down a little bit below this pivot point, which we've been watching as a possible support level. Well, we came down. It's really hard to see because there's a big P right there, but we actually gapped down and closed into this area. We're going to have to see, is the market going to continue to go down and try to fill this other gap that was created right after the election? But we're still above the 50-day moving average. On the bottom, you can see where we were above average with volume here. So seeing some weakness with the 20, 50, and 200-period moving average study of the S&P. We're no longer extreme, dropping below the midpoint with the Stochk RSI. Still above the midpoint, but dropping with the Williams percent R. Just a little bit above the midpoint with the CCI 14 and a little bit above the midpoint with the CCI 20. No extreme positive readings right now with these charts. Coming down in the short term, no longer extreme in the intermediate short term, coming down, but still extreme in the long short term. That's why stochastics are still on the list as extreme positive. Dropping and actually turning negative with the force index in the short term. The condition of the 20-period moving average. Now, this shows that we're vulnerable here because we're dropping below both the green line and the blue line, and we closed below that, and the lines are starting to roll over. But when we look at a simple and exponential moving average, we're below the exponential, but we're above the simple. We came down, dropped a little bit below that, but we were able to close above it. That means in the short term, on a trending basis, we are still positive as long as we hold above that. Now, on Monday or sometime in the upcoming week, if we drop down below this and close below it, that's going to turn the short-term trend to negative. And we're dropping below the midpoint here with our standard deviations chart. We're slightly below zero with the balance of power. That's negative. The condition of the intermediate term trend, 50 periods, dropping below the red line and the blue line now, showing a little bit of vulnerability there. Turning from dark blue to light blue with the go, no-go system, and right about at the midpoint here with the highest high values. The TTM squeeze, which was starting to get stronger, now it's looking more negative when it changes to the darker blue. And the ulcer index, this is another fear gauge, starting to go back up above the moving average after it had been declining. Standard deviation really dropping off as we're going back to price levels that we've seen not so long ago. And still barely positive here with the ease of movement. We're just less than a point, less than half a point above zero. The Arun is still positive. It's going sideways right now, but it's still above zero when we compare the green line with the red line. And we're negative here with the S&P McClellan oscillator, below zero and declining. When that happens, we're declining with the summation index based on price, and we're also declining based on volume. We were seeing this as the week was playing out, and this was causing us some concern. It's still causing us some concern because it's more negative. And we're also below zero and declining with the NYSE McClellan oscillator. So we're going down with the summation index based on price and volume. We've turned negative now with the Swenlin trading oscillator. We dropped below zero based on price, and after Thursday, we were slightly below zero based on volume. Now we're even more so. Seeing a little bit of a hit with the momentum rolling over with the PMO, but we haven't crossed below the moving average yet. Starting to turn down based on price. We never did go positive here based on volume. It came right up to the moving average and now is rolling over. So we're declining with the PMOs that are rising, the buy signals are declining, and we're starting to roll over with the PMOs above zero. Still positive with the slope oscillator, but it is rolling over a bit. Also rolling over with the MACD, but still above its moving average. So we're seeing some weakness and some concerns here, but we haven't switched over to negative in the short and intermediate term. We're still looking positive in the long term with the tricks and KST. Copy curve rolling over just a little bit, but still positive. And the Sean trend meter is declining, and it's still extreme since it's in this kind of sickly green area. It won't get back down to neutral until we get to this sickly, whatever color that is, kind of a yellowish thing. We're declining, but still above 50 with the money flow. We're below 50 with the ultimate oscillator. So these are our secondary indicators that are showing some vulnerability right now. Declining, but still above the moving average with on-balance volume. Declining, but still above 50 with the intermediate term RSI. Dropping below 50 with the RSI based on 9 periods, which is short term. We've gone from neutral to negative with the Elder's Impulse system with the S&P, but with the parabolic SAR, we haven't dropped enough yet to put the dots on top. This is still positive with the dots on underneath. And we're coming right down and just testing the short-term moving averages right here. And so far, they are holding. Are we going to be able to get a bounce up off of that, or are we going to break down below them? That's what we'll be watching for Monday. And the context is that we're declining with the bullish percent index, even though we're still above 50. We're also declining with the NYSE bullish percent index and declining with the NASDAQ 100 bullish percent index. Even though they're all positive since they're above 50, we are going down with all three of them. And we're coming back down into the short-term mini rainbow here. That's a 20-period simple moving average of the open, high, low, and close. We're right about at the midpoint here. Sometimes this mini rainbow, one of these lines, will end up providing support if we're coming down. And we're turning more negative here with the Heiken Ashi. Now we have the black candles. We're positive but pointing down with the Kegi chart. We're turning negative with the Renko chart with the red block there. And we're turning more negative with the three-line break. Long term, we're dropping below the red line here with our 150 and 200 period moving averages. So we've gone to negative now with the Keller market model with the NASDAQ 100. All the other indexes are still positive in the short, intermediate, and long term. We're still negative across the board with commodities. Bonds are negative based on price in the short and intermediate term. The dollar is still positive in the short and intermediate term and negative in the long term. And a lot of sectors really got hit. We had utilities, financials, which have been strong. Real estate was up actually a little bit, but you see tech and communication. These are growth areas. They got hit the hardest. Healthcare, they're not quite sure about this whole RFK Jr. thing happening. The market's initial reaction to that was, well, we might like it, but what's it going to screw up? What's it going to change? What new rules are there going to be, or rules that we've relied on that are going to go away? And so there was some negative reaction to that. And we saw an awful lot of red here. We're starting off, we had a BPI cross above 50, and you read this from the bottom up. And then a whole lot of negative happened. 19.1, 19, 18.9, 18.8, 18.7. Sounds like a countdown here. And we got back up to 19.2 here. So the NASDAQ was able to close up off of its lows. The tech sector had a MACD bearish crossover. Communication had a BPI cross below 80 after it had been strong, crossing below 70 with the BPI with the industrials. The euro sets a 52-week low, and the dollar just going up here, setting a new 52-week high. That's causing some pressure for stocks, but live large in Canada. They're setting new all-time highs here. I'm not really seeing much of a disconnect between the weighted and equal weighted version of the S&P right now. The Dow is just really going down after setting a recent all-time high. The diamonds are still neutral though. When looking at the Elder's Impulse system, we're coming right down to this R1 pivot point. That's holding us support for right now with the Nasdaq, but we drop below that with the R1 level with the Nasdaq 100. So we're seeing a little bit more weakness there. And we've gone from neutral to negative with the QQQs, with the Elder's Impulse system. The momentum is still positive, but we're rolling over. And another day or so, and we're probably going to drop below the moving average. And we've lost the 20-period moving average with the QQQs. And that happened in late October, early November. Then we had the election and boom, off to the races. Now things are coming back down. And we're so in the short term, the Qs, which is the ETF for the NASDAQ 100, that's actually turned to negative, where we're not negative yet with the S&P. Small caps, fly me to the moon, hard coming down here because of gravity. It's like we've come back down to where we opened after the election with the small caps. Very frustrating if that's your area of interest. Dropping below 50 with the Russell 2000 small caps here with the RSI coming down, but still above the 50-day moving average, rolling over, but hanging on to being positive with the momentum. Neutral to negative with the small caps, also declining with the mid caps as well, and turning from neutral to negative with the Elder's Impulse system for the mid caps. The Wilshire still above its 50-day moving average, down 1.32% after recently hitting an all-time high. Also seeing a drop back, but still above the 50-day moving average with the total US stock ETF. And the financials up 0.5%, just flirting around with all-time highs here. The FANG index got hit 2.7% after recently setting another all-time high. And we came right up to this short-term trend line. We were not able to close above that. We broke through it for a little while on Thursday, came back down. Now we're falling back down. We're wondering if this longer-term trend line will actually act as support. Apple was down 1.41%, still around its 50-day moving average. Amazon seeing over 4% of its gains going away here. And we're down 2.79%. Still have not seen a death cross with Microsoft, but starting to drop below the 50 and 200-day moving averages. Google was down 1.76%, but still above both moving averages. Meta was down 4%, dropping below their 5-day moving average. 50-day moving average. Nvidia down 3.26%, but still looking fairly solid here. You take these big stocks like this, and they have pretty sizable losses, and that's how the indexes are influenced. Where Tesla, after pulling back quite a bit, was actually up over 3%, and that helped the discretionary sector. Netflix, after setting an all-time high on Thursday, saw 1.59% taken off on Friday. And still seeing kind of a disconnect here between US stocks and world stocks. Lately, they both have been going down. You can see the red line, that's the S&P, and the black line, that's the world index going down. So we're seeing it in the short term, maybe starting to improve, but we're still declining with the longer term correlation. Oil just dropping now instead of going up because of Middle East escalation is actually continuing to fall. The dollar's continuing to rise. We're up into the higher 106 range now. We were up just a little bit with the 10-year yield. We were down just a little bit with the 10-year based on price. And after we'd been seeing some improvement here, now we're seeing more weakness with the Q to S&P growth to value ratio. Still looking pretty good here with discretionary to the S&P, but now we're coming back and falling below the moving average when we look at large cap growth versus large cap value. So seeing some weakness here with the large caps, still above the moving average with the mid caps, coming down to the moving average with the small caps. So what's our outlook for Monday? We are still positive. Now, there are some weak areas. Now, positive, I'm measuring by moving averages, but there is some internal things that are causing us some concern. We do have in the more intermediate term from now through probably the end of the year, we do have positive seasonality, which could go into January. But I'll show you the chart here in a moment. In the shorter term, the week that we're coming up to could have a few days of negative seasonality. And right now, it looks like we're just pulling back. We haven't switched over negative yet. It's just some profit taking that's happening. Where do we go from here? If we see more weakness, that's going to change our outlook. But for right now, it just looks like normal backing and filling after having a really big run up. We're going to get the NAHB Housing Market Index on Monday. And then keeping an eye on the geopolitical things that are happening here. Here is the economic calendar for the upcoming week. The big ones are going to be pretty much Thursday with weekly jobless claims. Yeah, we'll get LEI. I have that, even though a lot of folks don't think it's all that important, since a lot of the components are known before this even comes out. But we've been watching that more for is that signaling that we're going to go into a recession. And we're going to get the global U.S. manufacturing and services PMIs on Friday, as well as consumer sentiment. And here's a look at the upcoming week economically. Seasonally, we're neutral to positive across the board for November 18th. Now we're going to be in the week after options expiration, where it's pretty healthy here when you go back to 1980. But when you look at the chart here, you can see where during an election year, we have a few bumpy days that we might run into. Doesn't mean they're going to happen. This is just historically what has happened. And Monday, though, in 2023 was the most positive day of the week, but it's not the most positive day so far in 2024. And we're coming back into this time where this is what Tom Bowley is finding too, is some potential negative seasonality. But if you look at the bigger picture, we do have positive seasonality going forward. And also we have positive seasonality after this election chart and this other election chart as well. So the warning signs, we have this confirmed Hindenburg-Ullman. Our smart money indicators are now turning more negative. We're negative with the S&P and NYSE McClellan oscillators and summation indexes. The Swenlin trading oscillator is now full-blown negative based on price and volume. And the 5-day equity put call ratio is going up, which is negative. The ultimate oscillator has switched negative, and we're turning negative with the momentum of the NASDAQ 100. Then the positive signs are the vortex is still positive, but it's weakening. The green line's coming down as the red line's going up. Growth to value, when we look at it for the large caps, is hanging in there, but we want to see that turn and go back up. Another positive area, though, is discretionary to staples. That's holding up quite well. The 10-day equity put call ratio is going down, which is more positive. The advanced decline line for the S&P, we're right on the moving average, where we're seeing some of the other indexes drop below the moving average. And we're still positive since we're above 50 with the 20, 50, 100, and 200 moving average studies, but they've been showing some weakness. The parabolic SAR is still positive for right now. The bullish percent indexes, they're above 50, so they're positive, but they're declining. So the shorter term context is that they're negative. The oscillators showing some weakness, but still positive for right now. The ease of movement just barely above the positive level. The money flows still above 50. The financial sector is still holding up quite well. So our conclusion, we're still positive when taking everything together. Intermediate term positive, but short term negative when we look at seasonality. And I showed you the chart. We'd have some potentially bumpy days. Right now, it just looks like we're pulling back. In the short term, we're pulling back, and so far the 20-period simple moving average is holding on a closing basis. And we are seeing more weakness coming into the intermediate term, but we're still positive since we're above the 50-day moving average, and we're still positive in the long term. Thank you. I hope you have a great weekend, and I will talk to you in the next video.